All right. Hey, good morning, good afternoon. Sorry about the confusions. I had to move a meeting to Sunday, then brought it back to our regular schedule. Uh, just trying to grapple with a little bit of a parental duty. And when my kids schedule for the weekend, so she had a conference where she had to present, and I wanted to be there. But that kept moving, and so I had to move mine. So, but glad I'm here back at our regular schedule. Um, I guess maybe some probably didn't see a updated note and maybe waiting for a Sunday session, but let's give a few minutes for others to join. We, while we can chit chat about anything else that you want to. Good morning, Yanka. How are you?
Good. The market was down on Friday. Um,
Who
how did
cares?
you? Yeah, right. It's
So
a good buying opportunity. Did you buy anything yesterday?
I don't think so. Let me go back and see. I did not. I don't think I bought. Uh, I think maybe a couple of stocks where I had gone, I sold maybe put spread, but I did not buy any shares. Let me reconfirm. Nope, nope. Last share that I bought was 8:15 that weekend. I think that was the last one I shared. I'm looking at it. That's the last one I bought, which was Mercado Libre. And yeah, beyond after that, I have not bought any shares right now.
Vivek, do you sell puts to purchase, or do you put a limit order to purchase a good
No,
till
no,
can?
I'll sell a put or a put spread. So I sold a put spread on Broadcom on Friday.
Do you do any limit buy price and good till cancel?
I don't do any. I think maybe once in this year I'd set up a limit buy price for a stock where I was okay to buy at September, but that didn't even get executed. Otherwise, I don't do limit buy price, keep a limit order for buy price. I rather go and sell a put at that price point.
And take assignment if it goes down.
Yeah, and take assignment. Yeah, yeah. So right now, I think majority of my individual stocks, I will have, if I'm still willing to add more, then I'll probably have a iron condor on those individual stock. Like I have on Meta, I have iron condor on Tesla, I have it on Mercado Libre, I have it on ASML, I have it, which is now in the money. The put side is in the money. So I'll generally have a short put or a short put spread. And if it falls down at the price point at which I'm okay to buy, then I'll pick some shares. Otherwise, yeah, move on. Just rinse and repeat for the next month.
So,
Yeah.
Vivek, when you sell a short put,
Uh-huh.
um, does your brokerage account keep the money for the security, and then you can't use that money until that get executed or cancelled?
So I will. So it's not a the straight one word answer is yes, but there are nuances to it. It depends on what kind of a account you have, at what kind of a level, and what kind of a privilege you have. So, for example, if you only have cash account or level one, I guess option privileges, uh, and less than $25,000, then basically if you're selling a put, brokerage will hold 100% of your the value of the the put, they will block 100% of it. For example, if you sold a put for a stock at a strike price of 50, then the brokerage will, separate out $5,000 so that you cannot use it for any other purpose. That gets blocked just in case if your short put goes in the money and you have to take assignment, right? So these are like your IRA accounts, are your these called like cash accounts, right? No margin availability. Let's say if you have a margin available with your brokerage, you have more than $25,000 account and brokerage will give you margin. There's something called a reg T margin, regular T margin, in which I guess you get 50%, like 50% leeway in terms of the amount of money that get blocked. So the example that I just gave, in that case, let's say if you had sold a put for a strike price of 50, brokerage firm will block $2,500. So you still have, other 2,500 to use. If you as you become more experienced and then talk your brokerage firm, they will move. There's something called a portfolio margin, but they'll administer a test to you and you have to pass that test. And if you pass that test, you'll get what's called as a portfolio margin, not reg T margin, but it's better, which is portfolio margin. So which I have portfolio margin, and in that case, they'll block only 15%, right? So if I'm doing the same example, if I sell a short put at a strike price of 50, a brokerage firm is not going to block $5,000. It's not going to block $2,500, but it's only going to block $750, $800 for me. So because I'm on a portfolio margin account. So that's how the answer is yes, they will block it. But like I said, there are nuances to it. And now, as the stock moves, the amount of money that they would want to block also changes because they do their risk management. At the end of a day, brokerage is not going to take any risk if you fail to live up to your commitment of buying the stock. If the stock falls down below your strike price and you have to take an assignment, so brokerage will make sure that they hold enough money so that they are not liable for it. So that's how like kind of a margin works. At least that's what I'm aware of because I've gone through these 3 stages.
Thank you.
And also, you need a minimum amount to get the portfolio margin. I think it's about 125 to 150,000.
Yeah, that may be the case. I don't remember, but sure, probably there was some requirement, and maybe once I crossed that and then I did the test, I was granted portfolio margin.
And does that 150K has to be in a brokerage account? Does the like other account in the brokerage, but the like high yield saving accounts, does that count? Do you know?
I don't know.
It
Okay,
is the total account value in that brokerage.
I see. Thank you.
So you could still have your money sitting in the money market fund in the same brokerage account or in stocks or in cash, however, whichever way you want. But I guess the overall value of that brokerage account should be whatever the 150 or whatever that value is. All right,
Perfect.
so we got a few more folks. I'm glad. My apologies for switching the schedule. And like I was telling earlier, I'm trying to juggle between stuff that I had to do for my kid, and between this meeting, I really didn't want to cancel the meeting. So I thought, hey, if we meet on Sunday, let's see, some people can join, that's fine. But then I had to move it back to today. So my apologies. But I'm glad you guys are here. We can have probably more ad hoc discussion if you want to. What else before we jump? So today, at least things that I had on my mind was I do want to finish not the finish, but at least start the topic from our previous week, which was talking about these derivative-based ETFs like covered call ETFs, etc. Yield max. This is what I wanted to talk about. because we see a lot of retail investors. So some of these ETFs have gathered, tens of billions of dollars asset under management from mostly retail investors. But there are some, I would say, not dark side, but there are some things that we should be aware of before we jump into it or put all our money into it. So I do want to talk about some of the drawbacks of these covered call ETFs, and which situation they are great, which one they may not be, so that then you can make a decision if you want to be in those or not. What else? I did go through the SaaS valuation. I think maybe we should do it once a month. So I'll throw some charts around what's the current SaaS and that industry looks like. This is the first meeting after the end of a month, so I'll show my portfolio. Quick look at portfolio and S&P 500 changes that have happened. It was, I think, on yesterday, S&P 500 made the changes to its, not S&P Global made changes to the S&P 500, S&P 600, S&P 400 indices. So we're going to talk a little bit about that. All right, anything else? Cool, let's jump into it, and without further ado. So first of all, time to celebrate. Any guesses why? Definitely market is not the reason markets ended up red, but anyway.
Palantir and Dell just got accepted into the S&P 500.
Gotcha. Yes. So we've been talking about Palantir for almost 2 years now. I think it was the last year, January. We talked about Palantir and why I was bullish on the stock. Plus, what are the things that I'm still watching in this company? So I've not made it as a big part of my portfolio yet. But it's now joined S&P 500. So the company that, didn't get that love from Wall Street. This did not come through the regular IPO process, but it was a kind of a direct listing onto the exchanges. So Wall Street didn't get to make, the cut that they generally will in case of a normal IPO process. But anyway, here we are. So in the recent S&P 500 changes, now Palantir has joined the top 500 companies in America. So if you look at, and I think that probably was the reason why the stock after hours jumped. It was up, what, 7.5% after hours. It was all because of inclusion in this S&P 500.
So I did get it right. Now,
sorry?
if I could only do that, I said, so I did get it right.
Yeah, you did. Yes, that's what I'm saying. You nailed it. You nailed it right, Tim.
If I could only do that with the stock market, then we'll be good to, if I could only do that with the lottery numbers, I'll be good to go.
Hey, before you go and buy lottery, give me a call, okay? Yes. So that's it's time to celebrate. If you are a shareholder, it's a good day. And not just Palantir, Dell also joined. Basically, these are the two companies riding the bandwagon of AI. We'll see some other changes that have happened in S&P 500 a little later in the session today.
Curious about something. You said cover call ETFs. You're going to cover those. Are you talking about like Connie, Misty, and all the yield max ETFs?
Yeah. So I'll just take an example of one of the yield max. There are many of like yield max is one kind of a covered call ETFs. There are many. I'm also going to talk about. So Tim, the way I was looking at was there are many ETFs that I see that are in the market that make use of these derivatives like options, either to generate an income, which is like MSTY does, Connie. I guess there are on Teslas and all those. Plus, then there are ETFs that make use of these derivatives to give you portfolio protection. I'm going to talk about one of those. There are some ETFs that are called buffer ETFs. But the amount of money that these JP, let's say there is a JP MS, which is the biggest one. And I think along with the JP, there is QLDY or something like that. The amount of money that these ETFs have taken is insane, right? One of the most successful ETFs of past few years. If you take out the Bitcoin ETFs, these were like one of the most successful ETFs. So I do want to talk about the stuff that generally is not talked about those ETFs in terms of what are the things that you should watch out for, be careful. So yeah, I will cover those. All right, let's talk about the markets. 1 day performance. When we started, Niyanka mentioned, hey, the markets ended up in red on Friday. That is indeed the case. So the only place to hide maybe a little bit was on the defensive sectors, which is like healthcare, consumer staples, and real estate. Otherwise, doesn't matter. Even the financials were down. I mean, financials have performed really, really well this year. But even the biggest of the companies with a strong balance sheet, good cash flows, doesn't matter what kind of a company you are, what kind of a business you run, you just got hammered. NVIDIA is down 4%, Tesla is down 8.45%. Right? Amazon down almost 3.65%. Amazon has been kind of I would say almost a dead stock, not for past 3-4 years, haven't gone much in. So this is like three-year weekly chart. We're back here where Amazon was around in 2021, right? We're still hanging around over there. So if you were like unfortunate enough to buy at I guess this was the peak of 2021, we still haven't crossed that when it comes to Amazon. So one additional thing that I did on Friday was to plot the weekly move up 5% or down 5%. I think there was on CNBC, they were talking about S&P or tech sector is down 5% for the week. Then I thought maybe how about if I can find a way to put it on the chart? So this is what I put in. So the red arrows downward, you see that in this week, Amazon was closed down 5%. The green up arrows indicate these are the weeks when Amazon closed up 5% for the week. So looking at QQQ, yeah, this week we were down 5%. But then we had 2 weeks in last 1 month where we ended up more than 5%. The funny thing is around NVIDIA, which was like, it's almost $3 trillion stock. It used to be $3 trillion stock. Now I guess it is $2.5 trillion. It's behaving like a penny stock. Look at the wild movements that NVIDIA have had in this year itself. It had, I in fact counted and tweeted about it. It had, I guess, 12 or 11 5% up moves weekly, and then 1, 2, 3, 4, 5, 6 5% down moves. So that take out 18 weeks. They had a 5% move up or down. That's like behaving like a mid-cap stock, right? It doesn't look to be like a $3 trillion stock. But yeah, this is how it moves. This is how it's driven by a lot of AI sentiments. NVIDIA. So that's where we are. Any other stock you want to look at? But just give me an idea of, hey, so what I liked was like this XLU, right? No 5% up or down moves in this year.
Yeah, let's look at a stock called Berkshire Hathaway.
It says AMD. Let's look at AMD. 5% moves. Jesus. That's AMD is like every week, every few weeks, it'll make these big moves. So yeah, 5% down move, 5% up, 5% up, 5% down. So if you're an investor in any of these, but then you're not comfortable with the volatility, pick a right stock. Stocks like AMD is pretty volatile, right? I think it had more weeks when it actually moved 5% up or down than the weeks where it actually did not, right? Which
So
is
Vivek,
which
this
is
is
crazy.
this 5% is move from previous day value
Yeah, so it's like a 5% weekly change, right? So we can,
weekly.
yeah. So it's a 5% weekly change. We can configure it if you want to drop instead of a 5%, you want to look at 3% move, let's say, right? So then we can look about 3%. But yeah, it's basically a weekly percent change is what I was looking at. I mean, just an idea came to me because there was on the back end, CNBC was blaring that tech is down 5%. I thought, oh, maybe if I can find a way to plot it, just give me an idea. Yeah, so AMD is pretty volatile. Berkshire Hathaway. Berkshire Hathaway B, I have nothing to do with A. See, it hit all-time high. Berkshire Hathaway became the only non-tech company to hit $1 trillion valuation. Right? We're talking about a nanogenarian who doesn't know how to use computer. It's trouncing all the IT and the high-tech companies in terms of the valuation. It had only 1 week. No, that's also like last year. This year, no week where it actually moved more than 5%. So these are like silent killers, right? These are the companies which you won't see in the headlines because they don't make drastic movements, but it's still up 25%. It is handsomely beaten S&P 500 and it hit a new all-time high evaluation.
That's why it's in my portfolio. Nothing special, nothing sexy. 2 reasons that's happening. Number one, number three, he hasn't split the stock. Number two, he doesn't pay dividends. Number three, he's got like 6 insurance companies. So
Yeah.
he's got the cash on hand to keep reinvesting. That's why I got this S&P 500 ETFs, and then I got Bitcoin. One of them is going to make me rich. I don't know which one. I don't care.
Yeah, you can't go wrong with Berkshire. So if you and if you're right, the way they have structured so more than anything else, I think that the structure of the company, and I think it's very difficult to beat Berkshire because they get so much of a float from their insurance company that they just have a free money coming in. They're like net working capital is negative kind of a stuff. They get free money to wait and deploy. How do you beat that? So it's amazing business. And this kind of also mimic with like my options work, wherein you get money coming in, then you wait to deploy it. And while you wait for expiration period to, for it to work through your expiration period. That's why I love options. It's kind of a little bit of similarity of selling insurance. So if you sell options, you're selling insurance. But yeah, I mean, nothing sexy, never in news, not even a 1 week or 5% move. And it's in $1 trillion. I guess right now it's maybe a little less than $1 trillion, but it became the only
$700,000, something around that.
Yeah. But it became the only company to hit $1 trillion. So there's an interesting story around Berkshire B. So Tim, you said he won't split the stock. Yeah, but now we have a Berkshire Hathaway Class B shares, which is $400. And if you look at a Class A shares, which is what the original Berkshire shares was, which is now almost $700,000. Right?
Yeah.
So there is the reason why a Berkshire B is an interesting story around it, and which is why you will love Berkshire as a shareholder is that they have they focus towards creating value for shareholders in long term. The reason, and so I read through the history of it, and the reason why we had a B shares is there was like in Wall Street firms, right? So the Wall Street firms will be looking to benefit from whatever instruments that they can create and peddle to the retail investors. So there was one firm, what they wanted, because Berkshire Hathaway A-class shares were super expensive. Not everyone can afford it, right? I can't even buy one single share of Berkshire Hathaway. It's like $700,000, right? Whenever it was, maybe at that point of a time, whenever the shares B came around, even then it may be $20,000, $50,000, whatever. It was still out of a reach of most of the investors in US. So a Wall Street firm came up with an idea of, you know what, we're gonna buy the A shares, and then it's like you get let's say each one of you contribute $1,000, right? And we get a $20,000. I'm gonna buy one share of Berkshire Hathaway, and you get a units of, like, say, 10% in the stake in that unit of a share that I bought. And then basically I'll charge a fee for doing it. It's kind of a mutual fund stuff, but focused towards specifically around one particular share. But then they'll charge whatever percent, or I don't remember, like 150 basis points for doing it. And Warren Buffett was so pissed off about that someone is trying to just skim and rip off retail investors by being a middle person and giving exposure to Berkshire Hathaway. And then Warren told, okay, you know what? Forget about this. We're going to cut them off. I'm going to create B-class shares, which are much cheaper, so that retail investors can get into it. So that's the story behind. Because I also was surprised. I'm like, Warren Buffett, he never wanted to split. So why did he create a B-class shares? So that's the story. This is a fascinating one. He says, he was so disgusted by what the Wall Street firm was trying to do. Just like extract rent from retail investors to give them exposure. He says, okay, I'll give direct exposure. So that's the story. Anyway, any other stock? We want to say 5% moves. Otherwise, we'll move forward.
What about
S&P maybe?
Sorry,
what about Intel?
I missed both.
Go ahead, T.
I was just saying, what about Intel? It's another cheap stock that you could trade options on. It doesn't move much, it just ranges.
So I have given up on, and I tried these things during my early part of investing, but I've given up on trying to trade options on the stock just because it is cheap. Because I burnt my fingers on doing it, and sometimes you'll have a higher volatility, and then but the stocks are if stocks are cheap because the business is broken, I don't want to be selling or doing anything related to options. So I still have bodies in my investing graveyard, wherein hey, I sold options on a stock because stock was cheap and the volatility was high, and a lot of Twitter retailers were on it. And I like, oh, dude, I'm getting paid 5% for a month to sell a short put against it. Who cares? You do it like 5-10 times. You're like 50% already recovered your money. And I did do those mistakes, and those got assigned, and the shares are down like 80%. Right? So I don't do that anymore, T. My focus is now on, hey, if it is a good business that I want to own, then I will look at options and not the other way around. So everyone pays tuition. I have already paid my tuition. Good thing is I did it early in my career, so don't have to. I did it with a less dollar amounts.
Yeah, but the ones that typically have the implied volatility that's up there are usually around $10,000 and up for you to be able to, the amount needed necessary to trade options on it, because they're usually around $100 or up or so. I found BlackRock DGROW, which is $60 a month. It's an ETF that you can have. That's the cheapest one I found so far, but you still need $6,000 worth of capital. I was thinking about something that's in the $20 range, so therefore you only need like 2,000.
No, I mean, like I said, I'm not focused on looking at the ETF or the stock just because it is cheap and then to sell options. And I think maybe before you joined, we were talking about in terms of how much capital get blocked. So I don't have at least concern on the capital side. I don't use much of my capital anyway. So MU is our Micron technology. Let's look at how Micron did. Again, see, these all are AI darlings, and I won't say darlings, but basically AI stocks pretty volatile. Lot of move. I mean, it's right there. Micron had a 5% down move. This week was, and then 3 weeks ago it had 5% up move, another 5% up move, down, up. Yeah, pretty volatile stock. SMCI, Hindenburg. Oh, I should cover up that report. I did go through the whole short report of from Hindenburg. I don't own SMCI, but just because I never liked the margins on it. But I love to get into the short reports. There's so much to learn if you go through the short reports. A lot more learning in the short reports than reading a bullish report from an analyst. So whenever a new short report comes out, and Hindenburg does a good job, I make it a point to go and read it. They're generally long, so you should take out 2-3 hours to go through it. But there's so much things to learn. I think this year I've read maybe 3 or 4 of those. I don't own any of the stocks, but I still go and read it. Yeah, so SMCI has its own issues. The short report came out, then they delayed the results. There are allegations around. Maybe we'll talk about it. I'll take a note maybe to cover that in the next week. What are the allegations that Hindenburg has raised against SMCI? And then you can decide, what do you want to do with it. But yeah, it's looks like if it doesn't move 5% in a week, that's an abnormal week for SMCI. Almost every week it will make a 5% move, either up or down. Pretty volatile stock. So alrighty. Yeah, so this was a day performance. Weekly performance wasn't anything much to write about. Nvidia is down 12% for a week, right? Last week they reported results, and even though the results were great, I mean, what else could you ask for? 122% growth in revenue, data center growing at 154%, margins are like huge, like 60% operating margins, 30-40% return on invested capital, and the stock is down now 13% after earnings. It's all about expectations. It's all about that growth wasn't good enough, or the guidance of growing 80% next quarter. 80% companies will kill for growing 80%, right? But when you're comparing with, hey, you grew 122%, now you're gonna grow 80%, market doesn't like it. So, and the way Nvidia goes, the rest of the chip sector. So we see Broadcom is down 12% for a week. AVGO, AMD is down almost 8%. Qualcomm is down 6%. Texas Instrument is down 6.46%. Any Texas Instrument shareholders? TXN. So TXN keep popping up on my watch list because looks like it's a great stock from a capital allocation, etc. They do a good job. I've never owned it, but I'm wondering, anyone has some experience to share the TXN? Nope. All right. So basically chips are all down. Consumer electronics, not good. Communication services. I mean, all the tech sector for the week hasn't done good. Healthcare, I do see some greens in the healthcare or less reds in the healthcare. That's a defensive sector. Insurance has done okay. Oh, sorry. Financials are doing okay. For a week, Tesla still did better. It's plus. And this is where go defensive, right? consumer staples. Doesn't matter what happening in the market or economy, you still gotta eat. You still need your paper towels, your tissue paper. So, and you're still gonna drink your soda. So you see Pepsi, P&G, Walmart, you know, they're all doing fine. Energy was rout in energy because I think the Saudi nations, or I think the Middle East, I don't know which country was it, maybe Saudi Arabia or some one of those OPEC countries came out and told they're gonna increase the output. So you're gonna have a more production, and China hasn't recovered yet. So China is still lagging. China economy is still tight. So you're gonna have a more production with not corresponding increase in consumption. So that's gonna drive down the prices. We see energy is down for a week. ExxonMobil or Chevron all like 5-6%. What happened? So there's an energy ETF which I own, XLE. Yeah, it's been pretty down. Yeah, I mean it didn't have a 5% down rate, but doesn't really matter. Had a big red candles going around on XLE. It's up, barely up 2% for the year. So that's energy. What else? Industrials ended up in red. Maybe because of the concerns that US economy may be slowing down. I mean, the labor number, this whole route that we saw in market came out after the labor numbers came out. Non-farm payroll numbers came out on Friday, which kind of killed the market. But hey, it's only a day, right? So we had a job reports came out. Unemployment actually has dropped. So this is the funny thing. Unemployment has dropped from 4.3% to 4.2%. That should be a good news, right? For the market, that the unemployment is less, but then we see a softening trends in the jobs market. So there are three numbers on the job market that market actually pays attention to. One is the job openings. How many number of jobs are still open? So that fell to 7.7 million. This is the lowest level for the year. The number of jobs that are still open, unfilled, 7.7 million. So some of them could be ghost jobs. Who knows? But it is what it is. That's the data that market tracks. The second number that market loves to track is the ADP private employment data. So private employment data, new jobs added was 99,000, which is at the lowest level since 2021. So lowest level for the last 3 years. And then on Friday, we got a US non-farm payroll data that came out to 142,000, which is kind of a very below the expected 165,000. That is one issue that, hey, the non-farm payroll came lower than expected. But the worst thing is the previous month's averages, the previous month's figures were revised. So the last 2 months figures were revised by 86,000, which is like huge. So the 3-month average gains is now only 116,000, which is well below the average gains of 334,000. It's like less than, it's almost cut in half. Okay? So one thing which is like pisses me off is this whole continuous revisions. Can I even believe the number that come out the first time? If it's gonna get revised by like 86,000, figure in the next month release. What are those, the folks in this department doing, and how are they still able to retain their jobs by, having the numbers which are so way off month after month after month? Come on, guys. If you were working in a private company and you give like these forecasts, the CFO will be out after 2 months. If this is how they're gonna give the forecast to the street and it comes and then they revise the forecast, and change it at such a wide amount, they'll be out. But I guess if you're working for a government, you can still enjoy it, and you can suck at your job and still retain a job. But I don't even know whether we should believe any number that these agencies put forward if a month later that number get revised. I can understand, you can say, hey, this 5,000, 10,000 up or down, okay. Like 86,000, that changes the whole picture. That changes, now the market suddenly got spooked, saying, hey, the labor market is so weak. Are people not hiring enough? Are companies feeling the pinch? Are we entering into a recession that the labor market is now so weak? Did Fed did not cut it in July? Has that mistake cost us huge in terms of economic growth? That spooked the market. Anyway, only good thing that can come out of this bad labor numbers is, hey, Fed probably will maybe looking to cut 50 basis points instead of 25 basis points, right? So one thing is given, we're gonna get a rate cut in September, after September meeting. I guess September meeting is on 20th or somewhere, whenever the Fed meeting is. Now only question is, are we gonna get 25 basis points or 50 basis points? So there are two thoughts. One thought says, just give me 20, Fed should do only 25 basis points because market is already priced in. If Fed does 50 basis points, that's going to confirm the fears of the market, which is like, oh, the situation is really, really bad. Right? That the Fed is acknowledging that the situation is really bad, and we need to now prop up the markets by cutting 50 basis points. I don't know which side will win, but this is where the situation is. And September is generally a choppy market. Little bit of a seasonality into September, so that also plays in. And now we have an election coming up on November 5th. So a little bit uncertainty, all that combined together. But I guess the most impact came from this bad labor numbers. Market is risk off. I want to take any risk. So other risk on elements, let's look at, I don't think I have a table later on. So let's jump on to look at where the crypto stuff did for this week. We're now, Bitcoin is now 54K. I mean, Bitcoin and Ethereum are two biggest ones that drive the market. Is like 54K, which is okay, so not 1 day. So let's look at what, last 3 months. Right, we're back to, of course, we just ignored this yen carry trade, which was like a momentarily weakness in the market. We are back to where we were in July kind of time, given up all the gains of July and August on Bitcoin, and now we are back to 54K. Risk off. This is still considered as a risk investment. So risk off. Interesting chart. This one is September performance. Even September, what we are only a week in September. So from 31st of August to 6th of September, this the week that just went by. Like I said, it's a risk off, right? Tech sector, growth companies down 7% overall average. Tech and growth have lagged. Energy, we talked about. Energy has got more around the supply demand, but defensive sectors, which is like staples, utilities, they have outperformed the rest of the market. Staples is actually closed up. Utilities down, but barely. Real estate held up really nicely, but risk off. For at least this week, it is a risk off. Now, when the market broke after the yen carry trade in August first week, we saw the market rip back and cover everything. And I think we ended August, 5% or some percent up from that low of the first week. I don't know. Now we are in a kind of a similar situation. First week of September, market is down, S&P is down, whatever percent it is. Are we gonna rip back? Who knows? But this is where we are right now. Right now, market doesn't like risk. Other thing is yield curve is now steepening. If there was any indicator before the SAM indicator became a rage few months ago, the only other indicator that market could rely on to predict a recession was yield curve. We talked about the details of yield curve, why it was to be, it was the closest in predicting the recession. Basically, the 10 and the difference between 10 and 2-year maturity yields. The yield curve has been inverted for, probably that's the longest inversion, if we see it. No, maybe 1978 to 1980. That was like almost 2 years. This is 2022 to 2024. Yeah, probably the longest yield curve inversion that we have seen. But now, the yield curve is now uninverting, or you can call it as a steepening, is barely moved up the zero line. So this graph shows a difference between 10-year maturity and a 2-year maturity. And that went negative when the Fed started to increase the short-term interest rates. So the long-term were less, short-term was higher, and hence 10 minus 2 is negative, stayed negative. Now it is now steepening or uninverting. Now the bigger question is, every time, so these gray bands that you see are the recessions, right? Recessions have been invariably preceded by the steepening of the yield curve, right? Recession out here, yield curves uninversion here, recession here, uninversion here, recession here, uninversion, recession here, uninversion. So there's a market. Are we entering into recession? I'm not saying we are. It is almost impossible to predict the macro, but people do pay attention to these things. So, and want to position their portfolio accordingly. And if you think, oh, maybe we are entering into recession, and then you want to, sell off some of your stocks and move into cash, whatever, folks will do it. They'll do it, right? So that may be another reason that market is now suspecting that we may enter into recession. It may happen, may not happen, right? There are like 200 other factors that would be different from how the situation was in 2000 or 1980s, right? Fed has become a lot more active in terms of supplying liquidity. We have an election this year, right? The economy is a lot more integrated, that a lot of companies derive a lot of their sales from outside of US. That wasn't the case. So who knows whether we will actually get into recession or not. But people do try to find patterns. And one of the patterns, and now the yield curve has started to uninvert. And which invariably, if you look at the history, gets followed by a recession. But we will see. So, but these are the things that you'll see being discussed in the markets. All right, I see a couple of comments. Ramesh ji says ASML, LRCS, Broadcom, chip stocks got killed. Yeah, exactly. Chip stocks got killed. So I don't know what spooked Tesla. Does anyone know what spooked Tesla? What happened to that? The Tesla was down like 8% for the week. So Tesla still has to reveal their robo-taxi on October. So I was assuming that until then it will stay range bound, because you don't want to go short on Tesla. Never ever go short on Tesla. You never know. There are a lot of people, crazy people, who are diehard fan of Tesla stock. They don't want to go against them. But I don't know what happened on Tesla. I didn't catch any news in Tesla as such. Yeah, they recently had a run up. There was some news that why it ran up like it was up like 6%, etc. Maybe it just gave that up. Anyway, such as we already are, just not saying officially because of election. Oh, so it says we already are in recession. So again, technical definition of recession is 2 consecutive quarters of negative GDP growth, right? Or GDP contraction. I shouldn't say negative growth. That's like oxymoron, right? 2 consecutive quarters of GDP contraction is officially a recession. Does that matter in your day-to-day life? If it prolongs, probably yes. We actually had a recession. Technically, we had a recession during COVID. What happened to the markets? They're ripped higher, right? So first is, it is very difficult to predict macro. Number 2 is, even if a recession happens, how the stock market is going to react to it, we don't know. So it's a second degree of uncertainty. That's why it is impossible. And I don't want to base my investment thesis based on what's happening in the macro. It's trying to predict and profit from macro. It's a fool's errand. So it's a fool's game. I don't want to try that. Let's look at the sector performance. I don't think I've ever seen, ever since I've been actively investing, that the utilities has actually outperformed, the tech sector. Utilities outperformed the communication sector. Utilities had outperformed every other sector in the markets. Utilities are up almost 19% for the year. S&P is also doing nice, like 13%. Even though whatever happened on Friday, you might be thinking market crashes, situation is not good. Come on. How greedy can you be? It's up 13% for the year. What else you need? So it's okay. Nothing has gone wrong. It's just 1 week. You do see these corrections. You do see these volatility. If you don't have that, then how are we going to make money? So these are the times when you need to exercise your patience. So I actually read I forgot, where did I read this, or probably I heard this, and I like that, and I want to share it. I tweeted about it, but let me just bring that up, which was okay. Yeah, traits of a successful investor. Number 1, vision, to look far into the future, to identify what business is going to be life-changing, right? But what business, and then of course which companies are in that business. So you need to really have a vision to look 5-year, 10-year, 15-year out, just like the VCs will look out, right? Number 2, you need to have a courage to now invest based on that vision. And maybe for a long period of time, you'll just look like a fool. And number 2, that you're making prediction about future, which is uncertain. Thesis may work out, may not work out. So if you're investing in individual companies, you need to have that vision. Then you need to have a courage, and then you need to have the patience when the markets will rip you apart, and you'll see your stocks, nothing changing in the business, but the stocks are down 15%, right? You still need to hold through that volatility period, which is the price that we have to pay if we want to get the above normal, more than T-bill gains, right? There is no free lunch. Today you can make 3%, 4% in T-bills. But if you want to make more than that, you got to go through this volatility. And these are the tough periods when the market is testing you. Friday was just one of those tough periods. There are many. We have seen many in this year and even in previous years. But this is what will separate. And this is what's called, right? During these volatile times, this is where the wealth moves from the impatient to the patient ones. There's a transfer of wealth that happens. Anyway, so sector-wise, utilities are the best performing sector. And if you are diversified and not all in tech, you'll still be okay. Where did the fear and greed index? It swung from greed back to fear. See what a week. a week can change the sentiment so quickly. Yeah. What did I buy or sell? Nothing. I think earlier Nyanka was asking that, did I make any purchases on Friday? Not yet. I did sell some put spreads on some of the stocks that I have in my watch list. And that's why it is important to have a watch list, so that when market presents an opportunity, you can go back to your watch list and say, do I now really want to make a trade here? I did not buy any stocks. The last one, I think the stock that I bought was, and I did come and talk about it that week when I bought it, was a Mercado Libre, 15th of August. That was the last stock that I bought. All right, so next one I'm going to look at, this is our first meeting after the month end. And as always, I come and share my top 15 positions, what I hold in my portfolio. You should not follow this, but I want to be transparent because we do talk about stocks, and I just want to tell you what I hold, so that if I'm talking about a particular stock, you can make a decision. Am I really talking about it because the business is good, or I'm just trying to pump my bags, right? There are a lot of people who will do the latter. I've seen a lot of them on CNBCs who have no idea what the business is. Well, then they'll come and talk favorably. So just from the transparency perspective, I want to share my portfolio. Should not follow it. But you can ask questions if you have any questions. So end of August, SPY is still the biggest position. Almost 14.5%. Mercado Libre is close to 5%. Cash is down 5% from almost 10%. So the question that you may have is, did you deploy that cash? You said you didn't buy any stocks. You didn't buy much stocks. Where did the cash go? Fair question to ask. So this is a story. I thought I had access to the amount of a cash which I could deploy it. My wife said that she wants to buy some, she wants to have some cash available so that she wants to buy some property, which is, I'm not a big into real estate. I'm like, okay, I'm not going to touch that cash. So I moved that. I have segregated that portion of a cash. Now, assuming that I don't have access to that cash, let her deploy wherever she wants to. And hence the availability of cash for me to invest has come down. And hence that the rest of the percentages went up, the cash is down. So I will now work towards to increase the amount of a cash, because generally I would want to have close to 7 to 10% cash in my investable portfolio, right? So that cash, we haven't spent it, but it's in an account. I'm assuming I don't have access to it. So that's why that's where the cash percent has come down, right? Not that I bought and sold some stocks. And that has pushed up the other percentages respectively. So no change in top 15 overall, but I guess the ranking have changed. Some stocks have moved from one place to another, but overall top 15, no change in the leaderboard. So pretty stable, I guess. Any questions you have, feel free to ask. Otherwise, we're going to look at the pizza again after the end of September. And we'll see if anything changes by then. Right? Maybe Palantir moves up a few notches, who knows? But right now it is in top 15, but still small portion of portfolio. Any questions on any of the stocks? All right. So, okay. I do see I missed. Okay, the chat window was closed. So Ramesh says a cheaper rate will help some home builders like SPG, property, utility. Yeah, so I think that's where the home builders have done great this week, just because the rates will be cheaper and we might see positive, the uptrend in home buying activity. So real estate builders are doing. SPG is, that's a Simon Property Group, but that's a mall operator. So there's a little different between how the SPG will work and the pure play real estate players would be. But SPG is a kind of a REIT. They They deploy. Oh, it's still at 164. I remember trading in SPG during the COVID time frame. It was around 150, and I did. It's got a good. I think it's got a good dividend. Dividend yield. Yeah, 5%. And so I did trade it during COVID, and then not after that. It was around 150ish. So looks like it's still trading in the similar time zone. Time to buy gold at Costco. Now silver too. So I remember not few weeks ago when I walked into Costco, they were actually holding those pamphlets. Sir, gold. I'm like, what? Your gold is not being sold? I remember earlier, I think then the first time when Costco came up with the gold, and those were like, they just flew off the shelf. Right? You have to log in immediately online and order it. Otherwise, it was like out of a stock. But now they were actually holding and telling customers, buy gold. So I don't know where it is. Gold has done pretty well this year. It's GLD is a ETF. I consider it as a proxy of gold, done better than S&P 500. It is up almost 22%. What else can you ask for? Right, so let's look at the daily chart for it hit its kind of all-time high, I guess, 234 GLD. Yeah, and up 21%. Not bad at all. Not bad. So this is the pure play gold. So the other way to take exposure, which I am not a big fan, if you want a gold, GLD is the purest you can get closer to. Some people want to do GDX, which is your gold miner ETFs. But then you get subject to the vagaries of corporates and all that stuff. So yeah, it's still lagging almost 2%, 2.5% to the real GLD. Juniors probably will get more troubled. So that's even worse performance, 14.51%. Right. So if you want to have an exposure to gold, my main would be, and this is how I have exposure to gold. I hold GLD in a portfolio, which is, I guess, get closest to what gold price movement is. ALB, is that Albemarle? Albemarle. I never owned this company. Jeez, that doesn't look good. This is a miner, right? Is this a copper? Is this a copper? No, not copper mine. I think copper was FCX, Freeport McMoran. But this is also some miner company. I never owned this. So what is this? Some miner or lithium ion, something like that. Something has to do with it. What is this? Oh, lithium resource. Yeah, this is lithium mining. Yeah, so I think this was a rage during the whole EV. Now the EV market is a little tentative. I guess that's spooked Albemarle. I have no idea in terms of what the business is and how good the business is. But right now, one reason why the stock has done what it has done is because a lot of companies, even now Volkswagen, this week was a news, they have rolled back their 100% EV plan by 2030. Right? So many of the car manufacturers, they are going slow on EV and rather focusing more on the hybrid front. Right? So that would reduce the anticipated demand of lithium ion, which is a core component that gets into the lithium ion battery for EV. And that may be what is doing here. But like I said, I've never owned the stock and never watched this. You may want to look at it in terms of how they are doing from a business perspective, then decide whether you want to sell or not. And so I don't know whether you should sell or not. Depends on how big is this position and when did you buy it, etc., etc. But EV market is not that rosy that what we thought or the market was once predicted to be. All right, let's before that, let's get into the yield max stuff or the covered call ETF, because that's a topic from a previous week. Then we'll come back to the SaaS software valuation. Fair enough? Anything else? So we're gonna jump into the covered call derivative-based ETFs that I see in the markets. We'll focus on the dark side of it. What you should watch out for if you are invested in those, because there is no free lunch in when it comes to investing. If you are buying, if you are getting something, there is some cost that you are paying. There was a comment that now it's a good time to buy silver too. SLV is my go-to vehicle for silver. Has been just choppy for the year. It hasn't done barely. I think, yeah, it's up 17%. It's done better than S&P 500, but I guess since mid of May, it's been just chopping around. And this is what I love. I think every expiration period, I have a strangle or covered call or something on SLV. And so far, I think all of those, I think strangle closed out for profit. I mean, what can I do? I'll wait. If it stays choppy, it's not going to move much. Might as well reduce your cost basis, right? So I'm just looking at my, yeah, I did what? How many trades? I have one for October, which is still open. I have done 12 trades on SLV for this month. Either it's a strangle or it's a covered call, and just reduce the cost basis. Close all of them. Looks like they all went close positive because it's doesn't move much. Anyway, so we'll see when. But I have seen that silver moves. It moves big, right? Let's go back and maybe look at 5-year, 10-year data. 10-year, right? And so like movements like this, when it starts to move, it makes a huge moves. This was like just before the May. Here's some huge moves out here. Oh, look at the move out here, like close to 17 all the way to 30. So don't go and sell naked calls on SLV, right? There are Reddit folks who will just pump this up, and you'll get killed. But yeah, over the last few months, it hasn't done much. So, which helps us to reduce the cost basis while we wait for silver to do what it has to do. All right, let me look at where's my ETFs. So ETFs using derivatives. So that's going to be our next topic for discussion. So so there are many ETFs that I see in the markets, which basically make use of these derivatives, essentially calls and puts, to generate some sort of income, right? These are called covered call ETFs, right? And these are like actively managed funds. So you'll have a fund manager who is actively looking at, buying and selling these options to generate a little bit of an income for you. So there are a lot of funds who will generate that extra income by selling covered call options on the underlying stocks or indices, right? So we'll take an example of MSTR. If you take example of MSTR, that will be kind of an ETF that will have exposure to MicroStrategy stock movement. Remember my words, I'm saying it has an exposure to MicroStrategy stock movements. Right? It may not have MicroStrategy stock in its portfolio. It may not. There could be some ETFs which actually go and buy the underlying stock and then sell covered calls against it. While there are other ETF, and I guess MSTY is one of them, they don't buy the underlying stock. So they get a synthetic exposure to the movement of the stock price of MSTR, Microsoft strategy, right? And as an investor, you really don't care whether you get an exposure to micro strategy stock movement by holding the stock or by replicating it by using options, right? This is called a stock substitution strategy, which I've done it many times. I still hold an exposure to one ticker through the stock substitution. So I have 100% correlation to how the stock will move. That's how my option position will change, but I don't own any stock. So many of these ETFs will do is get a synthetic exposure, synthetic equivalent of stock movement, and so which will replicate how the stock will move, and then they sell covered calls against it, which is equivalent to having a stock in your portfolio and selling a covered call against it. When you sell a covered call against it, you generate some income, and that income you distribute it out to the holders as a dividend, right? And the reason why many of these ETFs have become so popular is because of the high dividend yield that they have, right? They will generally have a high yield like 7%, 8%, 10%, 15%, right? That's a kind of a dividend yield that they will be able to generate. Again, it is not guaranteed. Right? This is not like a company, a CFO coming and say, okay, we're going to pay you 6% dividend, and then they stick to that dividend. This is based on what the option premiums look like, the call option premium looks like in the market. And the reason why we are seeing a lot of these ETFs in the last 2-3 years, or a lot more interest in the ETFs in last 2-3 years, is because the call option premium is higher because the interest rates have gone higher. Right? So because there's the interest rates in the market, you guys know Fed has been increasing the interest rates since 2020. That has gone higher. So, and hence the call option premium has gone higher. And hence there are many the Wall Street firms that are now coming up with these instruments, because now they can afford to give you 7%, 8% dividend, which is pretty attractive as a retail investor. So a lot of folks who want to get an income-based strategy, who want to invest in a dividend-based instruments, are getting attracted towards these. Right? And also you can get some partial hedging, because you're selling a covered call means you're generating some income. So at least if the stock goes down, you have reduced your cost basis because you generated that income, and that gives you a partial hedge against the market drawdowns, right? So like one of my most favored way of hedging is selling calls against the positions that I hold, right? So buying a put is super expensive, doesn't work in long term. So I will always try to sell a call against indices, against the call against the stocks that I own. And $87 billion asset under management in these strategies. It was only $8 billion at the end of 2020. And the reason is because the interest rates have gone higher. So the call option premium is higher, and hence you're able to get these good dividends. What's going to happen when the Fed's going to reduce the interest rate? You're not going to get the same amount of dividend that you're getting right now. So first thing you need to understand that what is driving that huge dividend income is because the interest rates are higher. Okay. And if the interest is going to go down, which is it is expected to start going down from September meeting onwards, you will not be able to get the same amount of a premium when you're trying to sell a covered call option that you have been able to get it till date, right? You may not notice the difference because only 25 basis points, but let's say right now we are sitting at 525 basis points, and let's 6 months down the line, year down the line, we're looking at 300 basis points. That's almost like 225 basis point difference. So be aware that the reason why we're getting such a big dividend is because of the increase in the interest rates over the last 2 years. And hence, a lot of money has flown into these instruments, right? Some of the popular ones, JEPI. This is the first time, JEPI was, and I covered JEPI in one of our previous sessions long back. I don't recall right now which one was it, but maybe we can find that out. But it's the most famous one. It is the biggest one. It's got almost $35 billion asset under management, right? And it's giving yield of 7.5%. JEPQ so JEP is basically S&P 500 index, and it sell covered call against S&P 500. JEPQ does the same stuff, but it does for the NASDAQ 100 index, right? So they'll hold a NASDAQ 100 QQQ. Again, it could be a direct exposure to the stock or synthetic exposure to the stock, then selling a call against that option, against that position, generating income. Yield is 9.2. Then the Global X has got QYLD, which is same stuff coming from a different issuer, covered 1 month at the money covered call against NASDAQ 100, right? Global X, S&P, XYLD, so on and so forth. So you have a different issuers, and then they basically have a ETF which track or get exposure to either S&P 500 or NASDAQ or Russell 2000, and then sell covered calls against it, depending on which instrument you want to go with. Some of them sell covered call at the money, some little farther out of money. And then that will also determine what's the kind of a yield you are getting. Closer to at the money you sell, you'll be able to generate more income by selling that covered call, right? The premium is highest at the money. The farther away you go from at the money, you going to out of money, the premium income decreases, right? So if you're getting closer to at the money, that's where you get the highest premium. Expense ratio, something that we should pay attention to, is JEP is got 0.35, 0.35. All other are almost 60 basis points. Super high. If we were to get an exposure to S&P 500 index, SPY, what's the SPY expense ratio? Come on, SPY expense ratio, right? Will be less. I don't know. Does it show expense ratio out here? But that would be like, let's say, less than 10 basis points. I don't get expense ratio here, right? I think 0.07 or 0.08 or something like that. SPY expense ratio. 0.09. Okay, I was off by 2 basis points, 0.09. Right? Still, it's like 25% of what JEP charges you, right? And if you come out here, NEOS has got SPYI, which is charging almost 0.70 basis points. So you're paying a hefty amount of a fee to get into these trades, right? So it rose in popularity in 2020 because you have got the inbuilt hedge. So if your stock is going down in 2020, at least JEP, etc., they will perform less bad, right? Than if you had just held the individual stock. So this is S&P 500. Total return of S&P 500 in 2020 was negative 18%. JEP held it because you are able to generate 7-10% of income, right? So that basically gives you a cushion, and it was down only 3.5%. Right? Pretty good. When you see these stats, that's great. I'm able to get that hedge, which is where it does give you a hedge because you are generating that income. But like I said, there is no free lunch. So you can get an income. You had a better return in 2020. Super exciting for investors. And so these are like on S&P 500, right? Then I saw a lot of these individual ones that started to come in. So MSTR, which is an income generating ETF, ticker MSTY. So I covered that in session 197 last year. So let me just bring that back up so we can go through the details, because many of you are new, don't know about this, how the MSTR works. So this is how the inner workings of MSTR happen. All right, so what does MSTR do? And consider this as a kind of a generic framework that a lot of these covered call ETFs use. So the primary objective is to seek current income. It's not capital appreciation. The primary objective, first one, primary objective is to generate income, just like a dividend-focused ETF will be doing. Secondary is to get an exposure to the share price of common stock of MicroStrategy. That means this is where your capital gain or losses will come in, because now you have a similar exposure to as if the Microsoft strategy stock will move. Right? Fee and expenses, again, these things don't come cheap. Almost 1% fee. If you buy Microsoft strategy stock, what fee you pay? 0. You don't even have to pay the transaction fee nowadays. All brokerage firms have a 0 fee, right? So you don't pay any fee. If you're buying MSTY, you're paying 1%, right? So, okay, how do they do it? I'm not going to go through all the details. Why invest in this fund, first of all? It seeks to participate in a portion of the gains experienced by MSTR, right? It's not going to mimic 1:1. And the reason is because it's selling a call against the synthetic exposure. So at some point of time, you're going to cap the gains. You can't have, if a Microsoft strategy continues to go high, you're not going to get those gains continuously because you capped yourself, or this issuer has capped the gains by selling the covered call. So you may not fully participate in the gains. Now that depends on at what price point, right? At how many percent or what delta out of a money you sold a call options for. And number 2, you're not entitled to any dividend because you don't own stock. So this is number 1, it will cap its potential gains. This is what I talked about. If MSTR continues to go high, but it is subject to all the potential losses if it decreases in value. So your gains are capped, which is what your covered call strategy will also do, is your gains are capped. But if a stock goes down, if it goes down to 0, you are still exposed 100% for the stock to go down to 0. Right? This fund directly does not invest in MSTR. So, and hence they are not entitled to any dividend coming out of MSTR. I'm not sure MSTR whether pay dividend or not, but let's say if it was paying dividend, you're not entitled to any dividend. So then how are they able to get an exposure, some level of exposure to MSTR stock? That's where they create a synthetic covered call strategy. Means, first of all, they get a synthetic exposure to the price movement of Microsoft strategy. How do they get it? They basically will have let me see. Okay, so you get a synthetic exposure by buying a call option and selling a put option simultaneously. Right? So let me draw this out. We actually talked about this strategy in our options boot camp. If you want to just exposure to the movement, this is how you could do it. Let's take SPY, right? And if I'm buying, let's say 100 shares of SPY, all right, where's my trade? Say I buy 100 shares of SPY. Oh, geez, how many things have we tried here? Okay, let me close all of them. This is how my portfolio will look like. SPY goes higher, I'm going to make money. Goes lower, I'm going to lose money. Right? But then I have to put up 100 shares of SPY. Each share costs me $550. So capital gets blocked. The other way is I can go far out, get a synthetic exposure. Looks like Microsoft strategy does, they have a 6 months to 1 year. So let's say I'll go out 1 year. And so that puts me to somewhere around December, okay, 19 September 25, closest to 1 year. And I come here and then I'm going to 540 is the closest one. I'm going to sell a put at 540, buy a call at 540. this gives me synthetic exposure to the same stuff. Right. So now if you look at it, this green line is what my combo trade is. Almost same profile. Right? This is how I get a synthetic exposure to the movement of S&P 500 without owning the S&P 500 stock. Right? If I own the stock, which is this is my exposure. This is how the stock moves. This is how my portfolio will change if the stock moves up or down. This is a synthetic exposure. Focus on green line. Almost same. So here you created a synthetic exposure to the movement of SPY. That's how my portfolio will be impacted without owning the shares. And then you do, so this you get a synthetic log exposure, and then you do a covered call writing against this. Right? So then I could actually come and start selling covered calls. Let's say I'll sell a covered call month out, 45 days out, etc. So that would be looking at October. Where's October, 40 days out. I'll come and sell a covered call. Pick whatever, right? I don't know where MSTR, maybe we'll look at how far MSTR does it, right? You get, oops. And if I sell this, I get around $4, right? $4 at a $500 underlying stock is maybe a little less than 1% in 40 days. Let's say close to 1% I'll make it, right? Let's like 9.9% or whatever. So this is how the MSTY does, right? So they'll sell a cover call which is approximately 0 to 15% above. But how far did I go? I went to 560, which is 20, which is like a point, maybe 2%, sorry, 3 or 4% out. So this is now depending on different issuers, they will pick up a different strike price. But this is exactly what MSTY does. So that's one portion. So now you've given your money to Yield Max. So they received your money, but they didn't use that money to buy MSTR stock. Instead, they gained the synthetic exposure in which the cash outgo may be zero or maybe very less. So what do they do with that cash? They actually take that cash and invest in US treasuries, right? And then they also earn interest on the US treasuries. So they hold short-term US treasuries because, hey, you will need to have that cash available because you sold put option. And where you park that cash, you park it in US treasury. And then you get whatever interest you get in that US treasury, that also you distribute it to those who have invested in Yield Max. Right? So this is how this works. You get some income coming from your option covered call selling, and then there is some income coming from the cash that you invested in US treasury. So yeah, and so they buy 6 months to 1 year long. So I bought a synthetic exposure to 1 year, and then they sell short call or contracts, which is 1 month or less than expiration date. I went out 40 days, and then the cash is parked in 6 month to 2 year maturities. So that's how the MSTY works. Now let's go back and see. You get a decent return distribution. Decent yield derived from the option income as well as the US treasuries. And that's what attract a lot of people to invest in these. Now let's look at the stuff that is not generally talked about. One is the high expense ratio that we already looked at. Like MSTY, you're paying 1%. Right? And number two, you'll have uneven performance. Right? If it is a bear market like it was 2022, it will outperform the underlying. Right? If Microsoft strategy or if S&P 500 has been going down, like we had in 2022, JP will outperform S&P 500. And that was very much evident. S&P 500 was down 18% in 2022. JP was down only 3.5%. Pretty impressive. If it's a flat market doesn't go anywhere, it will slightly outperform because you're getting that income coming from your option side, right? But if it is a bull market, which is where the market generally 2/3 of the time, or maybe 3/4 of the time in a long run, market is generally bull market, it will underperform badly. So let's look at JP, extend the time horizon, not focus only on 2022, but let's look at JP, which one? This is JEPQ, which is QQQ, right? So your QQQ was 46%, your JEPQ returned 35%. You go to longer term performance, going to 2021, all that, right? JEPI, which is S&P 500, returned you 70%, whereas S&P 500 total return is 104%. Because the market has been, over the last 3-4 years, longer period, it's been a bull market. Were there some time in between wherein the market fell down and the JP would have outperformed? Sure, 2022 was that year. Similarly, looking at a QQQ, like 2014 onwards, if you have invested in QYLD, your total return, which means your dividend plus your capital appreciation on the QYLD, is 125%. Not bad, but it's pathetic if you compare with if I just held QQQ, which is like 500%. So understand these nuances of the return over a longer period of time versus a return in a particular time period when the market is choppy, right? So it performs well when the markets are not doing good because you got some cushion by selling it, by selling the covered call and generating fixed income by even having it in the treasuries. But what happens for bull market? Your treasuries underperform. And then in a bull market, a covered call is actually limiting how much upside you have. And that's the reason why in a longer term bull market, these strategies do not perform over longer term. So again, don't buy and just hold it just because it is giving you 10% dividend income, but you lost on a lot of a capital appreciation that you would have had. I would rather control when I want to, sell covered call or get aggressive on it. And that's why I don't invest in these instruments. But I sell covered call all the times. I sell short calls all the time. But then I can tone down of how much I want to sell, how far I want to sell, depending on, hey, do I anticipate markets to go higher or lower, right? But if you're investing in JP, JQLY, these instruments, they have to do it because that's what they're meant for. Even if there is a roaring bull market in front of you, they're still gonna do the covered call. But as an individual investor, I can decide, what, maybe I'll not do covered call for next 6 months because, oh gosh, the market is gonna rip higher because Fed is gonna reduce the interest rates. Why do I want to cut myself short by doing a covered call and limit my profits? Or maybe I'll do a covered call, but I'll only do 25% of what I generally do, right? You can decide that yourself and you don't have to pay any fee. In this case, you have to pay a fee and then you're going in assuming that they will always do a covered call, which generally if you're a full bull market, covered call don't perform. Maybe you could do this if you're only investing some portion which you're okay with that doesn't grow. So understand these things. One is the underperformance in bull markets. We shouldn't be surprised because you're selling covered call against it. This is another one, S&P 500 and Global X, different issuer. Look at the difference in return in the long term. S&P 500 up 128%. Your S&P is up 337%, whereas its covered call ETF returned only 128% to you. Other stuff. The reason why I actually wanted to cover this is the thing that I did, this one, which was for me, new learning, was around the taxes. We don't think about taxes. I mean, I knew that if you're selling a covered call, you're gonna, tap your gains, you're gonna limit your gains because that's how the covered call works. But what I did not realize is the distribution that you get, the dividend that you get from this covered call ETFs, because I've never bought any, so I never had to look in my tax statement. The dividend that you get from these. So this was the article that came on Wall Street Journal. At that time I thought, okay, I should come and talk about it in our Saturday session. Yeah, so same stuff. Investors are pouring into it. These are hot offerings, but what I want you to focus on is many covered call funds have high or unusual taxes because the dividends are non-qualified dividends. So the qualified dividends get taxed at a much lower rate. Non-qualified dividends get taxed at your whatever is your income tax rate is. So that just changes the whole dynamics, right? At the end of a day, you need to look at your investment post-tax, right? Investment return post-tax. So many of these covered call ETFs, the dividend that you get is a non-qualified dividend. So you get taxed at a higher rate, number one. So that could be a top bracket taxpayer, it could be 40% tax rate. Right? Now, I think they take an example of QYLD that we just looked at, which has about 8 billion in asset. Just 1% of the distributions were tax favored, qualified. All other were unqualified, non-qualified. JEPI, 1/5 of JEPI's payout came from a qualified dividends. So 80% will be taxed at a higher rate. Other one is sometimes these distributions get classified as a return of capital. Again, you have to look through your document of if you ever invested in JP or MSTY, how are those returns classified? If it gets classified as a return of capital, it reduces your cost basis, which means it will increase your capital gains. So you have a deferred tax. So these are the taxation points which I wasn't aware of that triggered me to, hey, I should come and talk about this in terms of how these funds are being taxed. Okay. Now, don't believe me. So I went ahead and picked up the document of YieldMax ETF, right? I'm like, is it? And then I picked up, this came from a YieldMax own website. Apple Option Income ETF. These are ordinary dividends, right? Qualified dividends, 0. So, hey, Wall Street could be wrong. But this is coming there from their own website. I downloaded this PDF from YieldMax website. Apple ETF total, you get all the dividends are ordinary income dividends, not a qualified dividends. AMD, all qualified. So look at every dividend, whether it's Apple, AMD, Amazon, Coin, YieldMax Coin, they're all non-qualified or ordinary dividends. So you're gonna tax, I'm just scrolling down, and they got MSFT, Moderna, Nvidia, Netflix, PayPal, Square, Tesla, ExxonMobil. What else do they have? YieldMax, wow. Yeah, so they have all these, so these all are unqualified or so-called ordinary dividends, right? So if you have invested in any of these, read through it, reach out to the issuer, but it pays sense if you read through the document to understand what are the tax implications, because paying 20% tax versus 40% tax, here their whole investment thesis has gone out of the door. Right? You are ending up paying like double amount of a tax than than what you were anticipating for. So this is why I wanted to bring up this. I've not seen anyone talk about it. This article was a trigger point for me to investigate. And then I picked up this document from PDF from a YieldMax website. This is primary YieldMax final 2023, because 24 is still not done. I think after 24 is done, you'll have another document on YieldMax website, which talks about how the 2024 dividend, what portion is ordinary dividend, what portion is a qualified dividend. Looks like 2023, everything was ordinary dividend, on which you end up paying a lot more as a taxes. Then the dividend that you receive, if you just held Apple as a shares, you would have received the dividend from Apple. That would have been all qualified dividend. You would have paid much lesser tax. And then if you're selling covered call against your Apple position by yourself, you're not paying that 1% fee. And then you control how much you want to sell covered calls, right? So it pays to maybe learn and do it yourself. So avoid these surprises at the end of a tax season, okay? So that was one thing I wanted to talk about. Ramesh, you said, what is the source of this article? This came in Wall Street Journal. So, and I forgot which day of Wall Street Journal was this, but I just took a, when I read through it, I just highlighted this and took a screenshot just to make sure I can come and talk about it. But then, like I said, you can go to YieldMax website. I didn't look into the Japanese one. Maybe Japanese, like he said, the article says has got 75%, which is, or sorry, 80%, which is non-qualified, 20%, which is qualified dividend. Maybe they have the similar PDF, which talks about the tax implications or the tax treatment of these dividends. So if you are invested in any of these covered call ETFs, understand that doesn't work in long term. If it's a bull market, then it will underperform, which because of your covered call selling. But that's okay. That's irrespective whether you do it or whether they do it. But the tax treatment is different. Okay. All right. So that's one kind of ETF. There's another ETF that we've seen, which is 100% downside protection. I won't go mad if you want to invest in this, but if today you're feeling that the markets are all-time high and I'm nearing retirement, or I'm already in retirement and I want to save my the portfolio that I have, but I don't want to completely get out of market, there are ETFs which are available which offer you 100% downside protection. Either you could do it on your own by putting a collar. Basically, all they do is put a collar around the position, which means buying a put for the protection, selling a call to sponsor that put. So now there are ETFs who do that, right? So no downside risk is a dream of stock investors, right? Which means what they do is, with treasury bill. So all these started to come in because now the treasury bills are, yielding 5%, and you can get, so what's the catch? There is nothing free lunch, right? So what's the catch? If we get a downside, 100% downside protection, the only catch is that you don't enjoy the upside. So stock market is already up 13% for the year, and you think that is good enough for you? You could just have these downside protection ETFs. But that means if stock market goes up another 13%, which may not be an abnormal stuff, like market have done more than 30% in its lifetime consecutively, right? So then you shouldn't be cursing yourself that, oh my God, I didn't enjoy the upside. So the way these ETFs work is they'll buy a put. It will be at the money put, so that if you invest in $100, underlying as $100, they'll buy at the money put, so that if the underlying goes below 100, you can sell it at 100. So it means you have a zero downside risk. But it costs you. But today, right now, because the interest rates are higher, you can actually sell a call to sponsor the put, and you may be able to sell a call at 105 or 110. So you have some upside, which is still there, another 5% upside, maybe 7% upside, which will sponsor this buying of put. So, but that's the upside you have. Generally, that upside will coincide with what's the prevailing interest rate. So if it is 5%, you'll have 5 to 6% upside, which is equivalent to saying, hey, I put that cash in the treasury bills. But this could be a more effective way of effective way of doing it. So there are, for example, I'll give you some tickers again. Large cap max buffer June ETF MAXJ. When this opened up in June, today we are sitting in September, things would be different. When it opened up in June and you bought, let's say you put in $100,000 or $10,000 in MAXJ, it had a 1-year hedge period starting from July 1st to June 30th, 2025. It had a starting gap of $10, 10.64%, means at the end of June 30th, 2025, if the stock market has gone up 30%, you are capped at 10.64%. You can't make more than 10.64% at the end of June 30th, 2025. And the protection, it protects you 99.5% because they have an expense ratio of 0.5%, right? It's 100% protection ETF. Now we are not in June, and we are 2 months already into it. July is over, August is over, September is first week. So now the cap and the buffer would have changed from 10.64% to 99.5%. So if you are investing in MAXJ today, understand what's the current buffer value is. It may not be 99.5%. It may be 80%. It may be 90%. That you need to know before you invest what's my current buffer is. But if you're investing these things, when they actually come out or when they start trading, at that point of a time, you have 100% protection with an upside cap that will be available if you search its prospectus, which will tell you how much is the, when this fund is launched, when this ETF is launched, how much the protection you have, which is 100%, but how much a cap you have. Other thing to watch out for is this protection is until June 30, 2025. So let's say if your portfolio had 50,000, you invested all that 50,000 in MAXJ when this ETF came out. So your understanding is, I got 100% protection. My portfolio is not going to go below 50,000, right? Ignore the expense ratio. Fair enough, 100% protection. That is incorrect way of thinking. The way you need to think about it is that at the end of 1 year, which means by end of June 30, 2025, I will be able to sell my portfolio at 50,000. What happened from now in between, portfolio value could go down to 45,000. It could go down to 40,000. That depends on what's happening in between that duration. But at the end of this 1 year period, you will be able to sell your portfolio for 50,000. But then you have to hold that portfolio for end of 1 year to get that protection. If your assumption is, I'll buy this, I got 100% protection, I need money for, pick a cost. I need to buy a new bike and I need, or maybe a new car and I need $50,000 after 6 months. Anyway, I got 100% protection. So, and I got a little bit of an upside. Even if it doesn't go upside, after 6 months, I'll withdraw my $50,000, go and buy my fancy car. You may be surprised that after the end of 6 months, you might end up with only $40,000 or $45,000. So this protection, if you hold it all through the maturity period, or called as current hedge period. Okay. So these are the two things you need to know. If you are buying it after it is issued, find out what the current buffer you have. It may not be, always check the buffer before investing. Okay. Because now the buffer would have changed. And understand that this protection or this buffer is if you hold it all through the hedge period. In between, things could happen. So don't get into it with the assumption that I'll sell it sooner, I'll get out of it sooner and still have the protection. You may not. That will surprise you. Okay. So these are called a few tickers if you want to take note of is MAXJ, ZJUL, Z July. Yeah, these are the two. I think the innovators issuer have, this is from iShare large cap. Maybe if you search for 100% protection ETF, you might find some more things, but evaluate these ETFs based on when these were issued. When these were issued, they had 100% protection. You are buying it later. What's your current buffer? Okay. Any questions on these ETFs? Now, anyone actually have exposure to these covered call ETFs? I think I know T, you have yield max ETFs. Anyone else have these protection ETFs? Let's say not even 100% protection, but other topic is which is called buffer ETFs. Kind of a same family, but they'll not give you 100% protection, but they'll protect, let's say 90%, means you are liable for first 10% drawdown, everything else below that is protected. Or first 5% drawdown, everything else below that is protected. And then you will be able to get a much higher upside. It's basically the combination of how, where you buy your put and how you get it sponsored by selling call. If you buy a put little farther out of money, it costs you less, means then you can go and sell a call which is farther out of money, means you have a more upside available to you. So there are a lot of instruments in this market. There are annuities that are based on these buffer ETFs. We saw these annuities in 2022 or 2023. It becomes a rage, right? Because everyone wants to issue it, because there are hefty fee that these issuers make. And you'll see these instruments coming in the market. I discussed one of those, many annuities in one of those sessions. So understand what you're getting into. Understand how they work in a different market scenario, what the fee that you are paying, what's the tax treatment that you're doing, that you are subjected to before you invest in these. These are money spinners for the issuers. So no wonder, like $83 billion in JEPI. And gosh, those who stayed in JEPI after 2023 have lost out on so much of a gain because markets have been ripped higher after 2022. Look at the 2022 or here. Look at the underperformance, the gap between these one. All right. Any other questions on these ETFs that make use of these options or derivatives instruments? Okay, nothing. Let's get into the SaaS valuations, where the market is trading those SaaS valuations. I got some charts for you, and then a few more, I guess a couple of other news items, and then we'll be done for today. All right. All right, let's get back. Roll it back up to where did SaaS software valuation. So this is again from a Clouded Judgment. I talked about Jamin Ball. If you are investor in SaaS companies, software companies, good one to follow. Can find his reference on Altimeter Capital. He's a partner at Altimeter Capital. So let's look at these are various cloud software companies. Q2 is now in the books. Maybe there are a few companies that are still reporting Q2 results, but largely it's in the books. So Jamin came up with, all these interesting charts that he does. So this tells you about the aggregate net new ARR, which is an annual recurring revenue, which is a metric for SaaS companies. How much of ARR, I mean, a lot of companies get valued based on how much of ARR you have. How much of a new ARR you're adding, right? Existing clients, because you have a long-term 3-year contractual obligation, so you're gonna get an ARR coming from existing client. Are you able to sell more? Are customers buying more? Will be indicated by the net new ARR. So this is a Q2 24 net new ARR added is $3.7 billion, which is less than what you did last year, which was $5.276 billion, which is still less than what you did in 2022, 5.176. So this 3.725 billion is lowest of past many 2 quarters. So it's tough, still tough selling software out there, right? So other way to look at it is it growing, right? Median year-over-year growth in net new ARR added. It's been actually falling down quarter over quarter. We thought we have a V-shaped recovery here, but nope. Q3, Q4, compared to quarter after quarter, it's been actually going down less than like 15%. So means the companies are not being able to add more customers or generate additional new ARRs. So whatever are the signed contracts, that will continue to flow into revenue. New contracts are tough to come by. It's tough to sell software still. Now this is, let's look at top 10 enterprise value to next 12 months of a revenue. Kind of a valuation figure. Right? They don't ask me why you're valuing on enterprise value and not really like, say, looking at a free cash flow. There is a reason he has also pointed out, which is true, that many of the companies don't even have a free cash flow. So enterprise value is market cap plus debt minus cash. Right? I don't want to only look at market cap, because if you only look at market cap, then there are companies that will leverage their balance sheet by taking on debt. And then if you only look at, P by E, which is, let's say, market cap divided by your earnings, you're missing out the whole component that they actually have leveraged their balance sheet. So when you look at an overall enterprise value, which does include debt, then you get the real picture. So Palantir, super, super expensive from an enterprise when you're looking at, like, this is not price to sales, but this is enterprise value to forward sales, right? Which is 21 times. It's not cheap. I know Palantir just got included in S&P 500. There's a lot of optimism. So the stock could still run up. It has already run up, 7.5% on Friday, but it's trading at a super, super expensive valuation. It's not cheap. 21 times of next 12 months revenue is what overall enterprise value is trading at. Samsara, Cloudflare. Top 10 average is 13.4. Overall median across all the SaaS companies that Altimeter Capital tracks is 5. So the dispersion seems to be really high. The bigger ones are really like on the higher side. That the median overall is 5, whereas the top 10 median is 13. Palantir is the most expensive one, with an operating margin of only 12%. And that's the reason why I'm not gone big on Palantir yet, is operating margin, I don't like it. Still very low. So be aware of this. Let's look at the multiples, right? What other multiples is market? So this is what the same one, enterprise value to next 12 months over a period of year, over last 8-9 years. The blue one tells you the median of SaaS valuation, enterprise value of next 12 months. Remember this, like June 2020, 2021. Insanity, wherein every VC, every fund will be buying these SaaS companies. We didn't care what valuation does it trade at. It was trading at almost at the peak 20 times EV of next 12 months revenue. Crazy, crazy stuff. Pre-COVID, long-term average was around what, 6 or 7, 7.8. And we were at 20. Now, all that air has been blown out of these SaaS companies. Now we are trading at a median is now 5x. Right? All that froth that was built into this valuation is now unwinding. And that is why we see a lot of those unprofitable companies' valuations have crashed down. Zoom used to be $500 stock. Right? Where it is right now. It was $600. Now it is remaining like 10% of what is the original value, 90% down. Twilio, TWLO. I'm just picking. You tell me some stocks. 457 to 58, like more than 80% down. Teladoc, like what do you call this? Like 95, 98% down. So it has come out of the valuations, the multiples have contracted. Right? Top 5. Forget about a median, but top 5 were trading at insanity at some point of a time. 80 times enterprise value. Still, top 5 is still trading at 14 times. Right? Pretty expensive. Let's say the next one is interesting one. As an investor, you could say, if it is a high growth company, I would rather pay up for the higher growth. I don't mind paying up for a higher growth company. So now here you have a median values for a high growth, mid growth, and a low growth. So what is a high growth? It's like growing your revenue greater than 27%. These are all revenue numbers. Okay, there's only one company that grows 30%. It used to be 30%. Mid growth is 15 to 30%. Right? Low growth is less than 15%. So if it is a low growth, I don't want to pay up for it. If it's a high growth, I don't mind paying for it, because in the SaaS, the whole, I think that our prevalent thinking is go grab the market, then you can milk the customers. So if we're growing really fast, I don't mind paying up right now for you, because I know you're going to milk those customers later in your life cycle. So if you look at a high growth median, it has come down from 35 to now 8.7. Mid growth, median growth is 8.1. Low growth is 3.8. So now if you are working for a SaaS company or for a software company, and you hear a pep talk from your CEO, CFO in terms of it's their job, right? To tell employees your stock options will be worth X number, X dollars. Market is not pricing it correctly. Market doesn't understand our strategy. Our shares should be worth much. Some of these numbers might help you. Why would market price you 10 times your next year revenue if you are growing at 6%? Median multiple for a 6% growth in revenue is 3.8x. Mr. CFO, market is not pricing us wrong. Don't go and ask this to CFO, okay? Or maybe you should. I asked once and then I got a comment that you're asking, like these questions, analysts ask them in a call. I'm like, I'm just an employee. I want to understand how we are performing. So anyway, Even if you don't ask, you know inherently that it's not that the market is mispricing you. This is a pep talk coming from CEO or CFO. What the market is pricing is based on what your revenue growth is projected to be. And if you have been growing at 15%, and then you expect that your share, and you have a revenue of $800 million, let's say $500 million, and you think your company will be worth $20 billion, you might want to look back at your assumption, right? Those days are gone. So these median multiples will help you to see where your company stands. Right? If you're working for a SaaS company, or if you're invested in a company, and let's say you bought the stock at X price, and you're hoping that that company will go back to an X price, just see how much that multiple comes out to be. Are you way far off? Is it in nearby of where the rest of the market is pricing in? Then you could. All right, so looks at EV to next 12 months of revenue. This is probably an eye chart, so let me expand this. Yeah, this is all companies. Palantir is 21x. Super expensive. Samsara, Cloudflare. These are the ones which are like median is 5x. These are the below median. The reason, now this only talk about your EV multiple. There could be many reasons why it is below, because the companies are not growing, or the return on invested capital is not big. So that's the second level. So don't go and buy, hey, you know what? Fastly is 2 times, whereas the Palantir is 20 times. So Fastly should get reevaluated, at least to the median. That may not happen. It depends on what's happening with Fastly as a company. As a stock, it is in the drain. Some part of time it hit 136. Now it's sitting at $5. So based on how the business is performing. Right? Now this, the final chart is EV to next 12 months divided by what's anticipated growth. So that basically tells you how much are you paying up today. So the median is 0.3x. And I think this will be better, right? Median is 0.4x. Adobe. So the Adobe may look cheap from other valuation perspective, but currently it is trading at a fair valuation based on what the growth is being priced in. So it's the enterprise value over next 12 months of revenue divided by how much is this expected consensus estimate of its growth. It's 1, right? So it is expensive than the rest of the lots. The other lots are trading at 0.4x. Right? If we were to look at it comparatively between where I want to invest between X and Y, given other factors are all the same, this is one way to look at is EV divided by the next 12 months revenue divided by the growth. Okay. So not a pretty picture yet. We are not out of the woods. It's not that the market, at least the public market, is not paying up for many of these SaaS companies. Private could be a different story. Private market, you don't have to come and justify it every quarter. So here's one link on the private one. No product, but a new AI company, Safe Super Intelligence. Founders are, one of the founders is ex-founder of OpenAI, Elias Sutskever. His name itself is good enough to raise $1 billion. Company is like a few months old. He left OpenAI, founded a new company saying we're going to create an AI which is safe. I don't know. What does that mean? We have no product, but they raised $1 billion. Right? So if you're in AI, you could still command and raise $1 billion without having a product. So that should tell you where we are on that life cycle of bubble or investing. We got a new $1 billion raised where we don't even have a product, but it's got a good pedigree of management or of owner. Ilya and OpenAI veteran Daniel and Apple AI chief, ex-Apple AI chief Daniel Gross. So it's been loaded, locked and loaded with heavyweights in AI, and hence you got to get a $1 billion raise. It's all a bet on these people. They don't even have a product. They just have an idea of creating safe super intelligence, right? And this is all cash funding. It's not that credits from Microsoft or credits from AWS like they gave it to Anthropic. It's all funding is all in cash. So we'll have to see what happens. Could it kill all other AI companies? Maybe. Who gonna raise another $1 billion? But we'll see. Sachin says, remind me of Nicola. Yeah, but let's see how far this continues. This craziness continues. Last thing, changes in S&P Global that have happened this weekend. 500, we got a this Erie indemnity actually is an addition. So 3 got added: Palantir, Dell, and insurance company. What went out? American Airlines, Etsy, and Bio-Rad. So those have been thrown out. These rejects might go in an ETF that we talked about, I think last week or a week before that, which is the trash from S&P, right? The companies that have been discarded from S&P actually tend to outperform S&P over 12 to 18 months period. So there's an ETF from a Research Associates, NIXT, which will begin trading from September 2024. So if you subscribe to that study and agree with it that those who are thrown away, who are discarded, someone's trash is other one treasure. If the trash of S&P 500 could be treasure for you, but you don't want to pick up individual companies, there's an ETF that will start trading on September 10, 2024. The ticker symbol is NIXT. Keep an eye on that. S&P Midcap 400. So which is a 400 mid-cap companies. So Bio-Rad, that was thrown out of S&P 500, has now moved into S&P 400 because its stock price declined. It is no longer in 500. So what is BIO? Yeah, I get it. Why it moved from 500 to now 400. Is no longer the big market cap company. And I don't know, American Airlines, same stuff. And Erie Indemnity, same stuff. So they all moved from S&P 500. Now they became mid caps. Same case on the 600. You got tons of additions and then tons of deletions. I don't know if you want to look at any one of these, but if you have these ETFs, they keep changing. And I mean, if you want to get exposure to mid caps or small caps, these are the ETFs which are available. Instead of trying to pick a particular company, you can get exposure through these ETFs. S&P small cap 600 and mid cap 400, there will be ETFs for this. All right, so that brings us to the end of today. Let me get through some comments. Do you have other investments beside gold and stocks? My house I own is an investment. What else? I mean, in the stocks, you can get exposure to gold through GLD, some silver. But I don't do any other fancy stuff. Okay, Ramesh says HYDR. What's that? Oh, sorry. I also have some crypto that I hold, but that's it. Hydrogen ETF. New market emerging for hydrogen. looking at this doesn't look like, wow, what a beating it has taken over the last 3-4 years. So there was another article, I didn't bring it in this, which was, I think, appeared in Wall Street Journal, is around thematic investing. And which is around how many investors have lost tons of money trying to pick a theme and invest in it. And I kind of identify because I lost some money in trying to invest in 3D theme, 3D printing and all that stuff. But anyway, so you're saying Japan is betting heavily on hydrogen instead of EV. So we do have, I mean, in Toyota does have a hydrogen, the Mirai model in US is a hydrogen fuel cell. But again, I know that today we don't have a big market of hydrogen run vehicles. I know it is clean. I guess the only thing that comes out of these is water. But I'll have to do and check, how many people, how big these companies want to be in it. If they are still looking at an initial proof of concept stage, not proof of concept, but hey, let's do a pilot and then figure it out, then I don't want to invest my money based on this. So I guess I will let market mature before I go in. It's based on, what me as a personally, how I want to handle my portfolio. At this point of a time, it could be, hey, it's gonna give you 5x, or it's gonna cut into half. Then I'm not interested in that research profile. So I need to do more research on this one. But I will have to see what's the company that is pursuing this and what's the company business fundamentals look like. There was a solid state battery, I think 3 years ago, 4 years ago. We looked at, there's a new company, right? Which is, gosh, I'm missing out the name of that. They also have a tie with Volkswagen. Solid state, these EV batteries. Stock hasn't done much. I mean, there was a pilot one. They got tied with Volkswagen. Maybe it'll some year it will perform, but only if it can survive for those many years. Given the fact now that companies are pulling back on EV, so unproven, maybe great ideas. I want to wait and see when it becomes a good business. So now I've not looked at anything around hydrogen. Alrighty. Any other questions? Otherwise, we are done for today.
What is your overall consensus on covered call ETFs? Yes or no?
On which ETF?
Any covered call ETF. Any covered call ETF.
Oh, like I said, if you want, I generally don't do it because I do cover call myself. And now there is a tax stuff that you need to be aware of. And the fact that, hey, your gains will be capped. If you're okay with all these things, fine. But I don't buy, I've never bought, and I don't plan to buy, because I can do covered calls and I can manage, not covered call, I manage the risk in my portfolio myself. And then I've, plus the unfavorable tax treatment that puts me out, puts me away from these covered call ETFs. So I'm not going to personally buy any of those.
Okay. Thanks, Vivek.
Alrighty, no problem, T. Okay, any other questions? Otherwise, we're done. Thank you, everyone. Looks like no more questions. So thank you for joining in today. Apologies for changing the schedule a couple of times. Hopefully, we'll stick to our Saturday meeting. But if there is any change, I'll change it on a meetup. And I have to cancel that change. I will also do that on the meetup. So just watch out for the email from meetups. Okay. All right. Goodbye, everyone. Talk to you next week. Bye-bye.